The London Bullion Market Association, or LBMA, is by far the largest organization facilitating the storage and trade of precious metals. Because of this, it makes sense to analyze the data they provide, both from the standpoint of a current snapshot in time, as well as from the standpoint of trends. In this article, I'm going to cover data leading up through the end of February of 2022. I'm also going to show a signal that can be used to confirm if a change in the gold to silver price ratio is likely to persist or revert, which should be of interest to anyone trading the gold to silver ratio. I'll start with storage, for which I have data starting in 2016. In this graph, we can see that over the past 5 years, the amount of gold and silver stored in London vaults has increased. It may be a little difficult to see because I put both metals on the same chart, but gold in storage has increased by 33% and silver has increased by 16%. The bulk of the increase in silver storage happened in the first part of this period, whereas the bulk of the increase in the gold storage occurred over the past 2 years. These ounces represent a lot of value. Using February's LBMA pricing, the gold is worth close to $600 billion, and the silver is worth about $26 billion. This large inventory is clear evidence that there are big players who prize these metals for their ability to store wealth in a concentrated form. Now, Warren Buffett would chide these people because, in his words, the metals do not pay interest or dividends. Now, with all due respect to Mr. Buffett for his prowess in the world of equities, his ignorance about the precious metals shows when he makes statements like these. Now, as I'll discuss in a minute, the owners of these metals do know how to make them produce income. Although the metal lies very still in the vaults, the metal is loaned out for interest and also is used as collateral. Now let's turn our attention to the relative weight of silver versus gold in storage. We can see that in 2016 there were roughly 4 ounces of silver stored for each ounce of gold. This number rose to approach 5 in the latter half of the past decade. However, as gold started flowing into LBMA vaults in the early portion of this decade, the ratio dropped steadily, and it currently stands at about 3.6. Now, there's nothing particularly magical about the 3.6 ratio. We can't use it to value one metal versus the other, but it is interesting to see the relative amount of each metal stored. I'll get around to what I think is driving the gold to silver price ratio in a few minutes. First, let's take a look at some clearing data. I believe the volume of transactions is the critical data to monitor. This graph shows the number of ounces of each metal that cleared per month for the past quarter of a century. Before I comment on this, I should clarify the differences between transactions and clearing. The LBMA members transact with each other throughout the course of each day. In each transaction, a short-term debt instrument is created. It is only at the end of each day that all of these transactions are cleared and title to the metal changes hands on the LBMA's books. When I say title is changed, it doesn't mean that the metal necessarily moves. There are about 30 ounces transacted for every ounce that's cleared. And for every ounce that's cleared, they may be an actual movement in and out of the vaults that can be measured in milligrams. Notice that the monthly clearing of gold has been quite stable at about 20 million ounces. The same cannot be said for silver. There have been high volume months where 300 to 400 million ounces of silver change ownership, but there have also been low volume months where only 50 to 100 million ounces of silver change ownership. On average, the volume of silver changing hands is an order of magnitude greater than that of gold. I'm not going to plot the clearing data in terms of dollars, and the reason is that the trend in the plot is more a reflection of the declining value of the dollar than anything of interest in gold and silver. What I can tell you is that the dollar clearing data for gold is much higher than it is for silver due to the relative difference in the price of the metals. Now let's take a look at the ratio of silver ounces cleared per month to gold ounces cleared per month. This is shown in this graph. The ratio of ounces cleared is plotted against the left axis. For interest, I have plotted the gold to silver price ratio on the right axis. What can we deduce from this chart? First, let's take a look at the data from 1996 through 2010. It was largely range-bound. During this time, the gold to silver ratio oscillated between 50 to 75. It did have some brief periods of time when it exited this channel, but those brief periods of time didn't last long. before the price ratio reverted back to being inside the channel. And the same can be said for the ratio of silver to gold ounces cleared on the LBMA. During this time period, the ratio varied between 5 and 10 ounces of silver cleared for every ounce of gold. But then notice what happened in the decade from 2012 to 2022. The number of ounces of silver cleared for every ounce of gold started to steadily climb. It broke out of its channel and continued to climb beyond 10 ounces of silver for each ounce of gold. The gold to silver ratio climbed with it, breaking out of its channel of 50 to 75 and reaching a new high of over 115. Holders of silver were incredulous. Why was this happening? One way to understand why the price of silver dropped relative to gold is to acknowledge that both metals are being used as money. Let me explain. As stated before, there is a huge quantity of gold and silver on deposit in the London vaults. This gold and silver doesn't move in the sense that we normally think of when we say move, but it does circulate quickly. What do I mean by that? What I mean is that the owners of gold and silver lend it using bullion banks as intermediaries. And although the gold and silver doesn't move, the claims on gold and silver, which act as high-powered currency, are vast and they move very quickly. How vast? This graphic from the LBMA shows the weekly transaction volume for each precious metal. In each week, $245 billion worth of gold flow and $31 billion worth of silver flow back-to-back various currency transactions. And that's an annual trade volume of $12.7 trillion and $1.6 trillion respectively. Think about that for a minute. The combined trade volume of gold and silver on the LBMA is over $14 trillion per year when annualized. That's greater than the gross domestic product of each country on Earth, with the exception of the United States. And it's about 1/6 of the world's domestic product. By the way, gross domestic product is a measure of the rate of money circulation. So let's say that the rate of circulation of claims on gold and silver in London is 1/6 that of the circulation of all the other monies in the world. That's really saying something. So what does this have to do with the gold to silver price ratio? And let's discuss that now. What you see here is the widely accepted quantity theory of money. This formula relates the quantity of money and its circulating velocity to the general level of prices and the volume of transactions of goods and services. Ever wonder how the velocity of money is calculated? This is it. The right-hand side of the formula represents gross domestic product, or GDP. It is the measure of total monetary transactions that occur. So when you divide GDP by the amount of money in circulation, both of which are measurable, you get a measure of money velocity. Again, you're probably wondering what this has to do with the relative price of gold and silver, and I'm working towards that. The general price level, which is a measure of the purchasing power of a given money, is impacted by the amount of money that exists, the velocity of circulation of that money, and the transaction volume of goods and services. When the quantity of money increases, it tends to push the price of goods and services up, which is really just another way of saying that the money won't buy as much. Similarly, when the velocity of that money increases, it also tends to push up the prices of goods and services. Again, this is simply a reflection that the money won't buy as much. It's pretty straightforward. So what happens when gold and silver, which are money, circulate more quickly? Again, the question should be, what happens when claims on gold and silver circulate more quickly? The answer is that their purchasing power goes down. With that in mind, take another look at the relative clearing data as it relates to gold and silver price ratio. It is clearly showing that the volume of cleared transactions in silver has increased relative to the volume of cleared transactions for gold over the past 10 years. And this isn't measured in dollar volume, this is measured in ounce volume. The natural consequence is that the value of silver relative to gold will be suppressed, and thus the gold to silver ratio will rise, and rise it has. The gold to silver ratio is very high relative to where it has been in the past. How does one use this information to make better decisions when it comes to trading the gold to silver ratio? Obviously, there was not a one-to-one correspondence between the ratio of clearing volumes to the ratio of gold to silver price. The gold to silver price ratio tends to bounce around a lot. The way I view the ounce data is as a confirmation signal. When we look at the period of time between 1996 and 2012, we can see that the movements in the gold to silver price ratio were not confirmed by trade velocity changes. For example, in 1998, 2007, and 2011, the gold to silver price ratio hit extremes on the downside, meaning that silver was relatively expensive. Since trade volume didn't confirm this move, one might conclude that the change in the gold to silver ratio wasn't a permanent thing and could be safely traded. In other words, one should sell silver and buy gold. By contrast, in 1997, 2003, and 2008, the gold to silver price ratio traded against the opposite extreme. Again, the change in the ratio wasn't confirmed by a change in the gold to silver trading volume, so one could again conclude that the gold to silver price ratio was tradable, not permanent, and one should sell gold to buy silver because silver was cheap relative to gold. But now, what about the change in the gold to silver ratio that happened in the past decade? Here's where the price suppressing power of silver velocity came into play. As more and more silver changed hands relative to gold, it had a suppressing effect on the price. The move higher in the gold to silver ratio was partly a result of this. As the gold to silver price ratio climbed above 75, the volume of trade data confirmed that the price ratio might continue to climb. And continue to climb, it certainly did, eventually hitting a point of 115 on the price ratio of gold to silver. And so, where does this leave us now? The gold to silver price ratio has declined from its recent peak of 115. The clearing velocity of silver has also declined, confirming the price ratio move. This suggests to me that the price ratio may continue to drop. We'll have to keep an eye on the clearing volume of silver relative to gold. If it continues to decline, and it gets back in the range of 5 to 10 ounces of silver clearing for every ounce of gold, then I would also expect that the gold to silver price ratio would fall back into the old channel of 50 to 75. I'll be a buyer of silver once I see the clearing data for silver decline below 10 ounces of silver for every ounce of gold cleared. For now, though, I think it's just as likely that the gold to silver price ratio has found a new range, and that range could have 75 as its low point. I think watching the clearing data on the LBMA is going to be critical over the next few months. And if it continues to decline, then I will again be a buyer of silver because I'll be seeing it as a bargain. Thanks for your attention.